Good afternoon or morning or evening, wherever you may be located. This is Kristina Kuprina, the Chief Economist at Sequoia Wealth Advisors, with our monthly update on the economy. The theme, not just for this webinar, but for the year, is disruptive abundance. And I'll explain why as we progress throughout this webinar. Couple of quick housekeeping things for any of you who are new, because we have a lot of new people, a lot of registrants this time. Keeps growing, so I want to make sure anyone that's new gets this information. The regulators have stated that we can no longer use the Q&A in webinars for reasons which I don't understand, but it is the rules. So if you would like to send in questions, if you are attending live, please send them to the email that you received the invite from, connect@sequoiawa.com. And Caitlin is standing by and she will send me the messages by Slack. And I will be sure to get all of your questions answered. Don't wait towards the end though, because sometimes they get a lot. Just send them throughout. If I answer them, I'll address that. But just anything, any burning questions, get them out, get them to Caitlin right away. So I'm sure to answer them in this live event. Many of you have sent the questions in advance, so I'll definitely get those covered today, as I also have incorporated some of them into the presentation today. Second housekeeping item, we are just waiting for our speaker to confirm dates for our live event coming up probably this spring at this point, because we're trying to get a lot of schedules aligned. But we will be having our live event most likely in Scotts Valley, California, is kind of a middle ground with less traffic for our Santa Cruz, Monterey, Carmel, and Bay Area clients for the live part. And we're also going to be live streaming by Zoom for everyone else. The event will happen and we'll let you know as soon as we get the dates finalized. So without further ado, let's jump into it. As you probably are well aware, a lot has happened since the last webinar in December. A lot's going on in the world, a lot's going on domestically, and a lot's going on economically. So what I'm trying to do here is just pull high levels, sort of touching a lot of areas of interest right now. I may not be able to do a deep dive in all of these just for time constraints we have today. So again, bring your questions, so I'm sure to answer them. But that being said, like I said, I'm covering a lot of different bases here. And the areas I'm going to look at the most, or talk about the most today, is going to be kind of AI. Lots of questions about AI, a lot of questions, kind of a high level. There's no shortage of information out there. Questionable, some of it, certainly, and a lot of predictions that there's no possible way anyone could know, but just a little bit touching on the economic components with that. A little bit talking a little bit about what's going on with the Fed. There's been a lot in the news recently, a lot of questions there, just kind of a high level touch base on that. Also, we're going to have a new Fed chair when Powell's term ends in February. So talk a little bit about that. Though again, as we know who the nominees are and or who the person's going to be, we'll get into this in more detail later into the spring. Talk a bit about the economy globally as well as nationally, and some state-specific things. A lot of questions around California recently, so I'll talk about those. Taxes, healthcare, and investing. So those are the questions that people want the most interest in. So that's where I'm going to go today. Again, going to keep reminding you to send your questions in because maybe I missed something. So disruptive abundance. I really want to talk about why that's a theme. It actually was a theme late last year, but I decided that it would be good just to kind of keep it in a calendar year of starting this. So each webinar will be that kind of element of this disruptive abundance. I want to talk about abundance. We need to talk maybe if time permits a little bit more about it later. It's abundance sometimes is seen as just financial abundance. Abundance goes well beyond that. Abundance could be time, abundance of time to do the things you enjoy. It can be abundance of relationships, abundance of opportunities to learn, develop, and grow as an individual. There's so many things that abundance can mean. For the context of the webinar, I'm going to focus more on the financial elements, but it will kind of bleed into some of these other areas. And that's sort of the direction that we're watching at this point. No secret to anyone, I'm sure, listening to this today, that we have an administration that likes to do a lot of stuff. And so there's been this constant policy shifts in the economic front that the markets and the economy and businesses have needed to navigate. This is unlikely to change, at least for the next 3 years. So in that space, everything I say today could at any time be enhanced or disrupted based on policy. We're just in that environment right now. We have some administrations or even periods of time in some administrations when there's much less going on. And that's certainly not the case over this last year and likely continuing on. So we're doing the best we can with the data we have now with the caveat, we don't know what's going to even happen tomorrow. So we just can go with what we know today. So in time stamping this is just a reminder, this is January 15th of 2026, subject to change, everything I say today in future dates. So we'll start with the AI. Thanks. There's been a lot of questions around that. I touched a little bit upon it last month, but I'll talk about a little bit more again. There's still questions and concerns around AI bubble, AI disruption, what it would do to jobs, things like that. Also the technological advances and the speed in which things are moving. I am by no means an expert in AI and how it works. So do not come to me for that information. Do I use it? Yes. I've used ChatGPT pretty much since it came out. It is amazing to see the speed in which, and the not only speed, but also the intelligence of that and the use that it has. There are many other AI options out there and people use them differently. And even something now as simple as a Google search will have Gemini popping in to give you the AI version. So it is becoming more spread out and used by more people. I'll tell you a quick funny story about that. Most of you know that I go to Peru twice a year in the Amazon of Peru. This is not a part of the world known for technological advancement. When I was there last spring, we talked a bit with our friends and people we know down there about AI because they live on their phones, and so they certainly, have access to it. And the response from most people was either confusion or complete lack of interest. When we were down there again last fall, they were using it. And I'm talking about using it to build buildings, using it in their own lives. AI, as primarily ChatGPT and other similar ones, were commonly used by people on their phones. So that in 6 months, in a part of the world that's not known for technological advancement, the use of it was pretty significantly widespread. And you can just shows you globally how fast this is changing. It was again fascinating to see that within 6-month period. The big picture of the AI is the increase in productivity. That has been really significant, and we're able to see this both on a national scale and also on individual company scales, and that does have a very big economic impact. So we're watching that very closely. The best analysis that I've seen at this point, again, is obviously a rapidly moving situation, is that there will be somewhere between a 6 to 7% of the working population will be displaced if AI grows at the rate that is most probable. Now, of course, technological advancement can move at different paces. It can move slower than expected or faster, but at the more median viewpoint, there's going to be this level of displacement, which sounds like a small number, but it's a lot of people. Now, we've had these displacements in the past. Every single time in our history, we've had a big technological advancement. Going back to the railroads and electricity, there has been this same process. In more recent times, you'd seen it with, say, the .com, right? And the disappearance of, say, bookstores and things like that, record stores, as more and more things were purchased online. So job displacement doesn't mean job loss, though it could be temporarily, because oftentimes people will find other lines of work. Another displacement that we saw was in the blue collar workforce when a lot of manufacturing was either automated or sent overseas. And you saw that displacement. And for the most part, people did find new work in either a different sector or a different area of the sector. So it was more of a displacement and a new job than it was complete lack of employment. This time around, you're going to see more of the effects in the white collar workforce. So it's going to be a bit different. Yes, automation will impact factories and manufacturing. However, the pretty rapid rate right now of manufacturing moving to the US may well offset that. Again, we're still watching. That area of moving manufacturing, at least certain types of manufacturing like chips and whatnot, to the US has been something that is so far been reasonably bipartisan, right? This was initiated under Biden. It's been continued and expanded under Trump. So it's one of those things that may have a lasting or staying power beyond who's in the White House or who's in Congress. But this time around, what we're looking at is what jobs are currently available and unfilled. There's a lot of jobs, high-paying jobs that are available and unfilled because people don't have the skill set. There's a skills mismatch to the work. And so can people be retrained or adapt to the new jobs that are available as jobs go away? The jobs at the biggest risk currently are entry-level jobs that can be done by AI. So, entry level, I say, because when you get to a certain level, at this point anyway, you have enough other skills and ways to use this that kind of transcends what AI can currently do. That could change in the future, but entry-level jobs, analysts and things like that, there's a number of different sectors. I went into that last month, so I won't go too much into it this month, where that is. So where this is important as if you're young and entering the workforce, or if you're making college decisions, or what degrees you're going to get, what you're going to do, consideration to the staying power of that job is probably something to look at before investing a lot of time and resources into it. In addition, if you're in the workforce now, what can you do to enhance your skills to be, more employable or more steadily employable as these changes take place? Think of yourself like a lifelong learner rather than I have a certain status in my company or a certain number of years of experience. I kind of tied in a lot of the questions around the job losses. We don't know. This is just the highest probability at this point of what disruptions may take place on the employment side of things. The thing that's different with this technology than, say, we'll just use the internet as an example, or a lot of other technological advancements throughout history, is there's sort of a race here. This is a bit of an arms race, but with technology, it's not just us, it's also the rest of the world, because whoever advances the furthest has a greater probability of taking over more power control within the world. So it's not just who has the bigger nuclear weapons anymore, the most, it is also who has the best technology. As this advances further and further, there is real geopolitical risk. And so that is a lot of what the current administration, I imagine future administrations, the same thing, are looking at. We cannot slow this down because we cannot get behind, because there's a true national security risk in addition to the usual innovation that goes within technology. Obviously, that also does lead to times when the technology does things that we would prefer it doesn't do. That's come up recently with some of the news headlines. I'm not going to call anybody out publicly, but many of you may have seen this. So it's very important that we have to accept that there's going to be things that will happen that we're going to need to correct for in this race to be first or to be best or to advance this technology. I'm certainly not getting into the good or bad or any of this, just more of the reality on the ground is that the technology is not going anywhere. It's not going to slow down. And we have to be mindful of what restrictions we put on it because of the national security element, because of the importance of this development, at the same time while protecting society. And ways to come back and correct when AI is doing things that we as a society think it shouldn't be doing. The fascinating thing about it is there's such a diversity of viewpoints, even within parties. So it's not a Democrat Republican thing like many topics are. It is literally within parties where you have Democrats saying, yes, we need this, grow, grow, grow. And Democrats saying, no, stop, it's bad for society. And Republicans the same way. And so it's not one of those things that are easily divided on partisan lines. It's more so comfort level with advancement and understanding the technology, as opposed to fear of the unknown, fear of change. That happens a lot of time when there's a rapid shift. One thing that will come up in the political space, and it's gotten a lot of attention, and I can correct a few things about it that not quite necessarily accurate in the media, which is the cost of power in the data centers. Now, no secret, the data centers are essential. We have to build a lot of them, a lot of them. The amount of power and energy these data centers use is phenomenal. I work in large numbers, and it's hard to wrap my mind around the needs of these, the data that's produced, as well as the needs of power for these data centers and the projections for what's needed going forward. Now, what I'm telling you is based on how we currently generate energy today. There is such a push now to find other ways to do this that I imagine these brilliant people that we have doing their brilliant work in innovation may well come up with a whole different way of doing this. We've heard stories about having it in space so we don't need to worry about, power, right? 24/7 sunlight, the cooling and all that goes away. So there's a lot of things that could happen in the future, but we're not there yet. But the demand for power is phenomenal. And we will need to build the infrastructure up to create that. And I'll just give you a really quick example. GE turbines, they're on back order until 2029. Like literally, there's just they just can't get to it. They're trying to find ways to make it happen. They're almost patching it together. Like, okay, we're gonna do some solar, and we're gonna have some generators, and we're gonna do this and that. We're gonna have our own power station, so we don't affect, the local power. There's just so many ideas that are coming up, and we're just again once there's even nuclear power. There's companies working on small nuclear reactors to do this. A lot of different ideas, a lot of different things being working on. But the thing where it ties into the politics a bit has been concerns about what this will do to the cost of energy for the average person, right? Because the idea of it is, okay, this data center is going to come in, it's going to suck all this power, it's going to drive up the cost for everybody. And I will say so far that hasn't been proven to be true. And we can just look at that. And the state of Virginia has more data centers than anywhere, maybe I believe possibly anywhere in the world, but definitely anywhere else in the United States, significantly more. Yet their cost of power has not meaningfully changed to the public. There's been lots of times in history when a large, power sucking thing, Lawrence Livermore, something like that, is plugged into the grid and it hasn't changed it. So data centers in themselves don't necessarily drive up the cost of power. A lot of that is more of a fear because it can happen if the grid is not prepared for it and there's not this work in advance to make sure whether they're, again, producing their own power or they're covering at least the costs. Like the infrastructure costs are not borne by the power users, the general population. So this is not necessarily the case if properly planned, and we get a lot of data. You heard me say this last month, but I'll repeat it again. The California, the cost of power in California, North, Con Ed South, PG&E North, is 77% higher than the average power in the United States. And California does not have that many data centers in relation to other states. The cost of California power has a lot of pieces to it. There's a lot of reasons California power is so much more expensive. Don't need to really get into that today. If you're curious, just ask me. But that just shows that the cost of power is not necessarily correlated to data centers. There's a lot of other factors that go into it. However, it will require proper planning. If a company wants to put a data center in, they're going to need to be able to show to the local power company and to the population, hey, this is not going to affect you. This can only potentially enhance because we're going to invest this much in infrastructure, which will reduce the future cost for maintaining this infrastructure to the general population. Again, we're watching this closely, but this will be a political thing because it is a news point that has been presented time and time again that the data centers are evil and they're taking all our power and things like that. And then there's another element too, for those that are concerned about the source of power, because there's a lot of different ways it can be traditional fossil fuels through green, clean energy and or nuclear, and how that builds out too would be maybe a second element, depending on that. So I want to touch upon this. Again, I know I'm covering a lot of different things. Other thing on AI, is there an AI bubble? We're finding out right now, right? Every quarter we get earnings. So with publicly traded companies, every quarter, they have to tell us how they're doing and they have to tell us the truth. No projections, no, they didn't give us guidance, but they're releasing how they did in the previous quarter. So that is always what we call the Great Reset. So we got Taiwan Semiconductor today, right? We're getting some information. A lot of the tech is on the back end of this, so we're probably about 3 or 4 weeks out at this point. But we always see this was a concern last year when earnings were coming out for the third quarter and the fourth quarter, and by and large, companies hit those numbers. There were some exceptions. There were a couple of companies that got ahead of themselves, and that will likely continue. As the stock prices continue to rise, the companies have to show not necessarily return on investment. People will pay more for a stock for future returns. That's generally how it works, but they have to show some movement forward, especially with these massive investments in technology. There are areas that are kind of around AI, especially in the lending space, that bear careful watching. And so I'm not trying to say it's all fine. We don't know because it will depend how high the prices get and also what the company earnings and guidance say. But collectively, no, it is just simply the demand is high enough that the investment is large enough, and that's driving up the stock prices. But ultimately, how the companies are doing will tell us. Just as a high level number, historically, when we're in a bubble, the investment in that area of global GDP, so a ball of wax, is usually somewhere around, in the low end, 3%, but generally around 5 to 7%. When you start seeing 5 to 7% of global GDP going into a specific sector, that's a really big watch point, especially when it gets over the 5, that there may be some risk there. Again, it can be substantiated, but it's more of a concern. AI spend right now, all in, is about 1% of global GDP. So if we're in a bubble, we are really in that bubble, barring, again, a shock. A shock would be some form of government shutdown or some huge disturbance in technology. I think right at this point, that's highly unlikely that we're going to have for a lot of reasons, but we're not collectively in a bubble, but we do have some areas of watch, and there are going to be some companies whose stock prices get hit here and there. Wouldn't even say don't invest in them. It means you're going to have volatility, but to have these great returns, will take short-term risk. So again, hopefully that's answering the bubble question. I'm going to go through the rest of it, and I'll take a quick break to check for more questions. Um, and I'm talking about the loss of jobs because I see, there's a lot of the questions here. And I kind of gave some examples about that in the past, but you can go back to when the phone systems changed, right? And what happened to all the switchboard operators, right? That's what a job was typically, a job, maybe entirely, but certainly typically held by women. And the jobs weren't needed anymore. So where did they go to work? And it's just that, so there was this consistent change of it's not this, it's not this. Before it was people that were, using horse-drawn carriages to move goods and people around. What happened as the automobile took? Generally, you have this restructure. There's another element to it that's a little bit more of a long game out there right now, because in the earlier stage of AI, it's more going to be a productivity assist than it's going to be a job replacement. And you're seeing that in the employment markets right now. You're seeing hiring slow down a lot. And a lot of times the media is like, whoa, hiring slowing down is dangerous. But we're also not seeing massive layoffs. We're seeing hiring, and we're seeing some layoffs. We're seeing hiring, some layoffs. Unemployment is very comfortably in the fours. That is well within the historic norms of a growing economy. Where you see the increases, it was at this very unsustainable and unhealthy rate in the threes when everything opened up post-pandemic. That's not good. Because what happened is you had a lot of people that didn't want to go back to work because they still had stimulus money, they still had the benefits that were temporary during the pandemic lockdown period, right? And those were available, so there was not this motivation to get back to work for a lot of people who were not working during the pandemic. So you have to actively be looking to be counted as unemployed, so that number dropped. And companies, they're opening up, they're like, we're hiring, come on, everybody, come work with us. So you had this imbalance that got us in the mid threes for a while, which is, again, not healthy for the economy. So being in the fours is a fine place to be. Don't be concerned with that rising rate. But there are individual jobs, though, that are going to be harder to find. Please understand when I'm talking about this, I'm talking about large national numbers. I completely understand that any job loss, any risk to job is very personally damaging and concerning. So it's a whole different world between what I'm talking about in the general economy. And the best advice I can give there is if you want to keep doing the same thing you're doing, just make sure that you're keeping your skill set up for what's needed in your specific industry or job, because it is changing. It's and hopefully, I say hopefully in many cases, and hopefully for individuals, it's a more of an assist than it is a disruption. So I'm going to finish up that, and I'll stop for questions. Let's see. Yeah, I think the big one on the data centers is that there's just the biggest constraint right now is local regulations or local areas not wanting them. And then fighting for other states or other areas. They're saying, yeah, we want them. We want the jobs. We want the opportunity. So that's kind of shifting where data centers are. There has to be the land. There has to be the resources. There also has to be the political will. So you're seeing some areas that are like, build it. And other areas that are saying, no, we don't want it. And that is the result of how people feel and based a lot on what they sort of consume. So take a super quick break here and just check. Okay, there's 3, so I'll mark these. Then I will head on. Okay, big things happening in the news. For all of you who heard this before, you've already heard this, but I'm just going to say it for the new people. My intention in doing this is to share information and data from an economic perspective, not to take political sides or social sides. That is for each individual listening to this today to decide on. And anything I'm saying is not designed in any way to change your mind or say one viewpoint is better than the other. It's just simply getting economic data out. The reason I say that is I'm delving into the danger zone. So let's see, should I start with the Fed? Yeah, Fed will be fast. Okay, Fed. For those of you who pay any attention to the news, have probably heard a lot of what happened over the weekend. This was a big news story. Quick backstory on the Fed. The Federal Reserve is independent from the government of the United States. It is independent, and its mandate is to protect the U.S. economy. I said protect and grow it, right? But to keep stability of the U.S. economy that's not impacted by the political whims of the White House and Congress, right? That idea. So their basic mandate outside of protecting our currency, right? And not our currency goes up and down. Remember, our currency goes down is actually really good for our exports. So it's no, that's not a concern. But the full faith and credit of the U.S. government standing mandate currency. The secondary mandate is inflation and employment. That's really their sort of job. And they do this by many different ways. The one most people know about is interest rate, controlling of interest rate. So when we had that huge inflation spike back in 2022, when inflation was over 9%, Fed gets in there, aggressively raises rates to try and tamp down inflation, right? So we have the fastest rate raise in history to try to control inflation. On the other hand, when the economy is showing weakness or rates are high and they feel like inflation's under control, they will lower rates. So that's a thing that most people hear about, but they have a lot of other tools in their toolbox. Last time they used this in a big way was in the pandemic to protect the economy, to stabilize things during the, obviously unprecedented shutdown and everything that was going on around that. But one thing that's critically important is the Fed is separate and is independent. Love or hate the current administration, there's been a whole lot of talk about not being happy with the current Fed chair and wanting to change. And that's going to happen anyway because his term's up in May. However, there's a lot of noise about that. And so that's gotten a lot of got a lot of media attention. It's also sometimes got a lot of market attention. But over the weekend, the Department of Justice went after the Fed for nothing to do with the chairman, but more so about the cost overruns for the remodeling of their buildings and wanting to get reporting on that and not getting answers and the requests, so now taking further action. However, the headline of that was seen as concerning by the markets on Monday morning because it was perceived in the media. It was kind of presented a little bit differently as to what the intention was, and that created the market volatility. When more clarity came out about what was actually happening, it wasn't Powell specifically, but it was about this other subject. The markets calmed down and have since been heading up. But I bring that up because that is one thing that we're going to be watching really closely in the short term. Who is the new nominee? And there'll probably be more than one in the beginning and they'll narrow them down. Who's a nominee? Are they qualified to do their job? And are they independent? Will they remain independent and not be coerced in any way by anything happening in Congress or the White House? We're watching that one closely. I can assure you the media, depending on what side of the aisle they're on, will tell you a lot of stories about that. But fortunately, I've got a lot of information and access to Washington, and I'll watch that closely because that is going to be something that's going to be critically important, is how the market takes it. And the market might be a little uncertain in the beginning until they get a feel for this person and get more information, but that will create a little bit of volatility in the spring. Another big one that's coming up is the Supreme Court any day now will rule on the tariffs. Why this is interesting is that the tariffs were really disruptive to the markets when they first came out. That went away with time as it became clear it wasn't going to be as much of an impact or an issue as originally feared. That being said, now that the government is raising phenomenal amounts of money off of these tariffs and it's getting into the Treasury and being used, the stopping of that is actually going to be equally disruptive or somewhat disruptive. We don't know yet because it's not just the Supreme Court ruling yes or no, it's also what off-ramp they give for other options for how tariffs can be done, or it's a hard stop, or is there time? So it's not just the ruling yes or no, it's also what is in the specifics. But that's coming up any day. So that could be, it'll be just noise. It's not anything you're going to act on, but it will be something certainly will get a lot of media noise and also a lot of responses from the market potentially. Okay, so then that was pretty quick. International space. So the weekend before we had obviously all the news about what took place in Venezuela. So from an economic perspective, I'll touch upon that one briefly. This has been a long running situation with Maduro down there. Biden had a pretty big price on his head, for lack of a better term. I mean, basically, if you bring him in, we'll give you this much money. Trump upped that and put even more pressure on him. And finally, the US went in and extracted him. I'm not going to get into all of the specifics, legalities, or anything like that. I'm not going to be providing any more value to you than what you'll hear in the media. Economically, the biggest thing is really what happens with the oil reserves there over time. This is not going to be a sudden event in any big scale because the infrastructure is in such bad shape. There's a lot that has to be done, and just removing the president doesn't remove the structural lack of law in that country. I know quite a bit about it because my people in South America, in Peru, talk about it a lot. They're really involved, right? It's kind of almost their backyard. And they know a lot about what's happening there. And there's been a huge problem because the country has so much crime. And we're talking about, not just low-level crime, but high-level crime. And that had been spreading throughout South America. Gangs from Venezuela, even Colombia coming in and creating a lot of problems. So it's been an issue for them. They've said to me for a long time, they really hope that guy they get rid of him. Somebody gets rid of him. It's been a concern. So a lot and people in South America have been concerned again about the crime from that. So obviously within the country, that's still entrenched, and it's going to take a long time, if at all, for that to go away. And so this is not, this is a great story. Yes, they have the largest oil reserves, and it's wonderful if we can work out some deals with them from even just a stability standpoint, right, in the region. But it's not going to be today's thing. And what it will do to the price of oil will have a lot to do, certainly with what's happening in Iran right now and everything else. So from an economic perspective, it's not going to have any meaningful difference. It's more going to be potential regime change in countries affected like Cuba and what's going to be the play from that. But again, had quite a few questions about that when it first happened. Quite a few about Greenland. I don't even know where to talk about with that one because it seems to be almost changing by the moment. Simply to say, there's a big difference between taking a country by force and a country votes for change. Greenland has the right to vote for their future, and how they vote, if they vote, and what happens there is really more of a national security situation, is perceived national security situation than is an economic situation at this time. So let's just table that for a future webinar when we might have a little more clarity with that. How much is noise and what, if anything, is actually going to happen will be the question of the day. Okay, before I hop in the economy, let's just see. I have 5. Okay, I'm just making sure I have enough time for all the questions. Okay, economy, US. So we got third quarter GDP, amazing growth. Not highest in history, but amazing growth, 4.3%. It's a very good number, really solid compared to the weakness we experienced earlier in the year. And it was unexpected in many ways. It was expected to be lower than that. So that does show a strengthening economy and a lot of different sectors, very much driven by consumer spending. That was really the big part of it. The fourth quarter, originally earlier in the quarter, was a slowing down quarter. We were hitting kind of this like soft patch. However, as we're starting to get data from the end of the fourth quarter now, it actually seems like it may have been stronger than we expected. I'm not sure that I'm going to go with the higher numbers that our president has announced. We don't know. We truly don't know at this point. Maybe it's true, maybe it's not. It's too soon. It's absolutely too soon to know. But we definitely saw more growth in the end of the fourth quarter than was expected, and it was happening earlier in the quarter. So that's a watch thing. And what is more important to me as an economist is not the high level number, it's the details that go into it. Same with employment, right? High level, what are the details that went into it? And so we want to look at where is the growth happening? Where is it not happening? Is this a temporary thing? Is it a more permanent thing? But right now, the economy is growing and expected to continue growing. And we won't get this last quarter, the fourth quarter, we'll get that. The preliminary will come out in February. So we'll kind of see, was that a blip or is that something that's more sustainable? But that's definitely something to watch. The economy. But it's definitely biggest thing has been the consumer spending. That has been the driver of this growth cycle. Business spending, interestingly, was relatively flat And the big reason for that is massive increase in productivity due to technology. However, there's a lot of tax benefits for companies that are expanding, developing not only R&D, but also other areas of spending. So we're going to watch closely to see on the fourth quarter if we start to saw business spending kick up over that, or was the offset from technological advancements and productivity kind of ate into all of that. Anyway, just more of a watching point than anything else, because again, it tells us where to invest in my world. Let's see, other questions. Questions about taxes. I think I'm going to save a lot of this for the next webinar because we're just starting in the beginning of the year as we get into tax season, kind of talking a little bit about that. None of them were really urgent questions. Only to touch into kind of people are talking about, the lower taxes for some people in the certain income levels, right? Especially below 150,000 for married, 750 for individual, those tax cuts and tax credits, expanded childcare into that. What stimulus that may bring into the economy as people get larger tax refunds or pay less in taxes. That's a watching point, and we're not really going to see that probably until after April, even though a lot of people who are getting credits file earlier. We want to kind of let that play out over time to see. But I did want to touch upon taxes themselves are not, it's not the only thing that eat into costs. You hear a lot of time tariffs are taxes, right? And they can be. So if a company has this increased input cost because of tariff, if they can offset it through technology or they can raise their prices, do anything else, it's a net neutral to them. But if they can't, they're kind of stuck. And so that's something where you see, but it's also regulations or taxes, right? The cost of regulations, especially in, say, healthcare, certainly our industry, right? Heavily regulated industries are also taxes, right? They're costs, they're input costs. So there's a lot of different things that can sometimes be done through policy that can increase or decrease costs. And you think, oh no, that's a company's problem, those regulations. No, you pay for it, just like tariffs, right? It gets passed on to the degree possible. So less regulations can reduce costs. Enhanced productivity really can decrease costs as well. So we're watching that, is that can also be sort of a helper with inflation. Is inflation, the year-over-year number hasn't come down much because it's so entrenched, but the month-over-month numbers are dropping rapidly. And we're going to keep an eye on that to see if it's a temporary thing or a permanent thing. And again, what went into that? What was the cause of that? Because that can tell you if declining inflation is a recessionary warner or if it's simply a productivity or economic enhancer. I think because of taxes, I'll pull into all the California questions. That's perfect. Looking at my time here. So a lot of questions about the wealth tax. Again, it's been in the news. A lot of people I heard about. This is California specific, but I'll bring it up. Basically, some large, powerful unions in California are proposing and are gathering signatures now to put something on the ballot, which is a wealth tax on billionaires. And it's basically 5 point something%, I don't know the exact number, of the wealth, not the income, not the gains, but the wealth of people that have over $1 billion that are residents of California from this year on, right? So kind of a little bit of a back thing. Question is going to be, is that actually going to pass? And the answer is probably. There's not that many, there's 200 of them or so, and probably a lot less now because a whole lot of them have left recently, so there's probably a lot less. They're not a big voting bloc, and it's very populist, right? Billionaires should pay more for taxes. But even if it passes, there's a lot of legal questions about the legality of it. There's a lot of precedence in taxing people on their wealth, not on their income. I won't get into the legalities of it. Simple AI search will give you all this information. You don't need me. But also taxing people that no longer live in a state. This has been tried before and it has not passed legal muster. So just because it passes doesn't mean it can be enforced. It'll probably spend a long time in the courts. But if it is successful for any way, shape, or form, it certainly will set precedents, and other states may join in with this. So we may have people bouncing all over the place, right? But that being said, from an economic perspective, it's a terrible idea. It's not often I agree with Gavin Newsom, but I agree with him on this one. It's a terrible idea because in California, most all, it's again, it kind of varies between, say 40 and 60%, depending on the economy, of the taxes are paid by the wealthiest people. like the top 10%, are paying almost all the taxes that California collects to pay for and fund all of the programs and services and police and firefighters and roads and all the rest of the things that we need are funded by this. So unless you meaningfully change the taxation structure of California and bring it to having more people pay more taxes, there's a great dependency on this. 10% of the taxes are just in the stock options that employees get for working for these companies, these tech companies, or any companies, right? They're publicly traded. So stock option alone are 10% of the revenue. So there's going to be a pretty big impact to driving people out, even if they're leaving just because they're not certain, right? It's a really, really big deal, and it's going to have a significant impact on California's budget. So this is, I get the populist idea about it. I completely understand the rationale behind it and why people would support it. But economically, it's really a poor idea. Just the amount of money that's already left publicly, not counting all the ones that are doing it quietly, but publicly it's you can calculate the numbers. It's pretty significant, and that's money that's not getting to programs and not getting into infrastructure or things that's needed. The other thing is, even if it passed, even if it was successful, even if all 200 people were there and the wealth didn't change, and you were able to tax that full 5%, based on the spending rate of California, and assuming the economy stays good and nothing bad happens, like a Goldilocks scenario, the money will last 3 to 7 years, and they're going to run out, and they're going to need more money to fund these programs, and they're going to have to go to other people for this money. So it's a kind of one of those things. It's just if you got enough people willing to pay the high taxes, you probably want to keep them. Again, a little bit of my opinion in there, but I am looking at this economically, like completely economically, the effects that this will have on the state and its ability, just even in the short term of people leaving, not even if the thing never passes. So it's a challenge, but anybody can put ballots up that gather enough signatures. There is a good possibility this may get negotiated out somehow or another. I'm not sure how, because Newsom absolutely doesn't want to raise taxes. He made that very clear, despite pressure to do so. But in the past, when you had that, if you heard the $20 minimum wage for a large company, fast food workers, that was going to be much more onerous, but it was negotiated so you could keep it off the ballot, right? So that may happen between now and then. Probably the vast majority, if not the entirety of the people listening to this, are not impacted by it this directly, but you would be if there was these cuts to programs due to loss of revenue. So bringing that one up here, making sure I have enough time for all the questions. And I'm going to grab the last one and hop into questions. Investing. So lots of questions around investing. Markets are really high. Should I be downsizing or diversifying or getting out? That's a natural thing. People get nervous when markets are going up a lot. They're fearful of a bubble or fearful of a correction. I can tell you, expect corrections this year. I would be pleasantly surprised if we didn't get one, but also we probably will. Historically, midterm years are years of volatility, right? They're years of volatility. It's just historically the way it is. So that's one part of it. The other part of it, the market has run up a lot. It really would love an excuse to correct. Corrections on markets are healthy. Up, lets them air out, go up again. It is a healthy thing. The further it goes up, the harder the fall is, even if it's temporary. Just the way that the markets work. So that being said, it wouldn't be unhealthy. It would be fine. It would depend what the trigger was. My guess, policy, but it could be anything, right? So expect volatility. Money you need in the short term simply should not be in the stock market, in any market environment. Make sure you are part. If you're my client, and I know you, we got that. If you're doing this on your own, just make absolutely sure is enticing as it is to be fully invested when things are going up at the rate they've been going up over this last year. Prudence is important. So really important that you have the proper balance of your assets, the proper balance. How much you keep conservative, how much you keep moderate, how much you keep growth, how much you keep liquid, how much you can keep illiquid will depend very much on the individual situation. And one thing is diversification. Usually when we have this big run up, this big rump in the market has been very concentrated on a handful of companies, a small handful of companies. So the prudent thing is to look at diversifying and just kind of spreading out. Doesn't mean you have to get out of the market, but making sure that you're not all in S&P 500, that you're looking at other areas of the market. That's prudent anytime that you have a big run up that's very concentrated like that. Again, should not be construed as advice. Definitely talk to me, talk to your advisor, or whatever resources you use if you're an individual investor, because everybody's situation is different and everyone's risk tolerance is different. What one person thinks is just fine is another person, I'm going to lose way too much sleep. So that's an important thing to know. Um, there is a lot, though, outside of the AI space that people think about. There's a lot of things out there that kind of touch upon it, like data centers, automation, all of the technology that goes into it, all of the resources and infrastructure that goes into it. I'm not going to say any stock names here because regulators don't like that, but I'm just thinking of a company here that you would never think of and related to technology or AI. Actually, I can think of a bunch of them that are great. They're doing amazingly well just because of what's happening with data centers and AI. So it doesn't think outside of tech. There's a lot of other things out there right now. Um, and the real estate market, I got three questions about that. So I'm going to take just a minute with that. Real estate is very, very localized, very localized. So there's not really I can give you national numbers, but there's so huge difference. There's areas of the real estate is not doing well, and there's areas of real estate is booming. So you can take that national number, but you're just aggregating a lot of data, and it's probably not useful to most investors or most people looking to buy a home. I will say that interest rates are likely to go down, barring, again, a shock to the system. So how you finance and the timing of this, you can't time it necessarily perfectly, but just have that consideration there. But most certainly work with professionals about your specific situation when you're making that decision to invest. It's a different story if you are buying your home you're going to live in. More important than what the real estate market is doing is, are you where you need to be or want to be? That's more important, right? You're living in a home is a very different thought process. There, the most important thing is you can easily and comfortably afford the cost of keeping that home if something happens in life, job loss, illness, anything like that. You do not want to lose your home, so make sure that you have ample resources and don't stretch yourself too far. Those are just general guidances. Again, reach out with specific questions because it's so specific. So with that being said, I'm going to go over to the questions now just to make sure I get them covered. I will skip past any questions that I covered in my talk, but if I know who you are, I will reach out to you if I feel like I didn't fully cover it. AI and jobs, how will this impact education? That is actually really an interesting one. We are such in the early stages. I probably can't get into that too in depth. There's, I'm sure, the balance between how students who are in school at age appropriate, grade appropriate level are using AI because they can't tell them not to do, oh, you have to think everything through by yourself, isn't very practical because that's not the real world. At the same time, you don't want to take away people's ability to think for themselves and understand how to process and the uniqueness of neuroplasticity. I'm sure very good teachers who understand this will develop curriculum that will make sense in this world. But I would say that the understanding and being a native, comfortable user with technology and being able to adapt to the rapid changes that will be happening in all of our lifetimes is going to be a really critical aspect of it. Also, if you're investing in a college education for yourself or your family, just consider cost to benefit, right? There's a lot of degrees out there that cost just as much but have less value. And you want to make sure that if you do have at this degree, that you also have the skills necessary to just be able to earn a living or to be able to not come out of school in heavy debt and not be able to get a job that will pay you a good wage. And again, this is very general. Some people don't go to college because they care about money. And the degree is more of a passion, but just be aware and mindful of the fact that the environment's changing rapidly, and you want to really have that as a consideration before making an investment of your time as well as your money. That would be probably the best thing I can add to that. Let's see, more questions about Greenland. I think I touched upon that one to best as anyone knows today. Let's see, we'll say today I covered that one. What are the effects of tariffs on our farmers? In the news, it's saying that some are going bankrupt. I feel like I covered this a lot previously, so I'll just touch upon it briefly. The farmers at the most risk are ones that have one single buyer and one single commodity that they can't sell elsewhere. So something times that farmers will say that the tariffs or this disruption change is putting them at risk. There's may well be other factors there. It depends a lot on what the farmers are growing. A commodity like a soybean is traded, if it's a raw soybean, right? Not oil from it or something like that. It's a commodity. It has a price. It's a set price. It's global price. If one's not buying from me, someone else will, unless the demand for soybeans globally goes down. So those people will be easier for them to pivot. They have a non-perishable, or not short-term perishable product that they're growing that has a global demand and a global price. So if China doesn't buy from you, Europe will, right? You can adapt a lot more. More challenges come with more perishable or more specialized products. So if you were growing something that is, and I'm just picking on China here because they're China, right? It's the tariff thing and a kind of a little bit of we're in competition with them. So if you're growing something that is really more specific for their market and there's not other buyers globally and there's not a set price for it globally, those farmers certainly could run into risk because they did concentrate their risk more so on one buyer or one specific. So I can't get into any specific stories. The challenge of the media is that if someone has a narrative, they're going to find somebody that matches that narrative and they're going to promote it as that's what everyone's experiencing or a large population's experiencing. But we haven't seen that in a meaningful way to date, right? And we're already in past the harvest season and we're getting into the winter and the planting and haven't seen a major change. What we'll watch for is what the spring planting looks like and how much that's changed in the crops that people are putting in. What is the update on the K-shaped economy you talked about last time? I talked about that briefly. It's also been in the media a bit, so I'll touch upon the K-shaped economy is that if you imagine the letter K, we're seeing the big growth being primarily at the middle class and the upper class side of the economic scale. Actually, I might even pull up a chart for you all. I said you like them. Maybe I'll show you these charts in the few minutes I've left. So that being said, the K-shape is that the people who own assets were benefiting and growing and the economy doing much better in this economy than the people without. And I kind of talked about the whys of that before. This is not unusual when we have this growth spurt in the economy, is that you see people with asset appreciation benefiting first off, and then it kind of comes down more, to that. Inflation is more of an impact on the lower end of the socioeconomic scale. The loss of some of the pandemic era stimulus has had more of an impact on that end of the socioeconomic scale. So there's a lot of factors that are playing out into this right now. So as inflation continues to minimize and as there's more adoption, we'll start to watch and see is the last couple of times since financial crisis this has happened, does that bottom leg start to pick up? And so it's not uncommon that early on in the recovery that be the case. The big watch point is going to be the spring when we start seeing, because remember this tax credits, even if you don't pay taxes, you get a tax credit, right? So it impacts a greater part of our economy. I'm going to go through the questions really quick and see more. I think I answered that question about the 5% GDP. We don't know yet. I'll skip past that one. There's some political stuff in here that I think I won't be able to offer much value to. And I do totally respect your questions. I just, in the interest of time, I really want to make sure it's the most valuable. Know that you can reach out at Connect@Sequoia WA and I'll personally answer your questions, or you can reach out to me directly if you have my information and I'll answer these questions. I am not ignoring anybody. I just want to make sure it's really helpful to this. This is such new news. I don't have an answer for you. But it's kind of interesting to see. What do you think about Trump's new healthcare plan? It was announced today that he has a healthcare plan and it's pretty wide reaching, covers a lot of areas of healthcare. I just, at a high level, saw a couple of points. I've been too busy today to be able to look at it in any detail. So one thing to say is proposal is great. Does it get through Congress? If this moves along in a meaningful way, I'll definitely get into more detail when I understand it better, because again, this just came out today. And also proposals are one thing, is it getting through Congress? We'll see if it's going to be meaningful. The thing about healthcare is we really do need to figure out a solution. The current, fighting about it is not working. The cost of healthcare has gone up 30%, 30% since the pandemic. And what it is kind of like the systems have been more important, or the systems and processes. I guess the best way of saying is it's been more important than the people, right, receiving healthcare. So you got this 30% increase in cost. We're arguing about how to pay for it. We keep the special stimulus over the pandemic in place, right, for ACA people, but it's shot up everywhere. The cost for employers has skyrocketed. The cost of it's not just for the unions too, it's skyrocketed. For all people providing healthcare or getting healthcare to the population, it's skyrocketed. So throwing more money at it is not going to be a solution. It's not tenable, right? Just keep going up and up. Insurance companies, hey, more money, cool. We don't have to control cost. Someone else is paying for it. That's not going to solve the issue. And we're not getting better patient outcomes. That's a bigger issue. We're not getting better patient outcomes. The wait times are longer. There needs to be a better way of doing this. Solution, a lot of great ideas out there. Maybe it's a talk for another webinar. So I'm just, I don't care where it comes from. I hope in a bipartisan way that we can figure out a better way of doing it, because the current system is not better. And so again, we'll talk more about that. I have more information. I covered that one. I covered that one. And what's the most important? I think it's a good finishing question. What's the most important thing to do given all of the uncertainty? This is really, you guys have heard me say this before, individualized planning and strategy is critically important, because there's not just the uncertainty you hear in the media every day. There's also life, and life is full of uncertainty in itself. So planning is the most important thing you could do, because what one person should do is going to be entirely different than what somebody else should do. How much you should react to what's happening in the world and how much you should just ignore the whole thing. I'm talking about when it comes to your financial strategy, not your consumption of media. So this is very individualized, very personal, and I would just definitely say in the situation that talk to us, talk to your advisor, or find somebody that can do some form of comprehensive planning, ideally fee-based. There's not an incentive to sell a product to you, and really just look at your individual situation, because the what to do is so much greater than how to invest. So much greater. Investing, important, yes, but it's not the be all and end all of any of this type of planning. I have a couple minutes left. If you don't mind, I know this is not in any order. You've heard me say this before. I like to be fully present when talking to you. I feel like I'm in a room full of everyone listening to this live, as well as all the people who are listening to this later. So I have a challenge when it goes to going back and forth to screen sharing and being present. That's why it's fun when I get my speakers in, because they can do this themselves and not. But I'm going to take one moment to show you a couple charts. And when you get to the recording of this, you'll be able to have these. Also, if you want me to send them to you, I can, because I put all the little regulatory stuff on there that's required. So if you can see this just very quickly, some of the things we talked about. This is one I want to say, ignore these giant spikes here and here. That's a pandemic. That was just a weird time. But this is sort of GDP, how the US economy is doing at any given time. So for people that are thinking, oh my gosh, the economy's terrible, we're in a recession. Right now, this is the last quarter we have, the third quarter. We're doing pretty dang well by historical averages. Yes, we've had higher and yes, we've had lower, but historical average here since the 1970s has been about 2.9. So we are a bit above that now. Obviously, quarter to quarter can change, but I like to show you in context of what's happened before. The other one, we hear a lot about unemployment. It's getting worse. Nobody's hiring, how terrible everything is. Quick shot on this chart here. I just want to separate the two here. U6 is unemployment. So this yellow line is underemployment. Sorry, U6 is underemployment. That's people that are working a part-time job. They're working below what their capacity is by working. It doesn't mean a bad economy. Some people want to work part-time. They want to be home with their kids. They have other things to do in life. They don't need to work all the time. They're caregiving for their parents. They're helping, they're doing other things. So just because someone is a U6 working part-time, not full-time, does not mean the economy's terrible. There's no jobs. There are more jobs than there are people looking right now. So I just want to throw that out there on a high level. When I say more jobs, remember it, all jobs, not necessarily the ones you want to do. The U6 is the U3 is actual people unemployed. So as you can see, taking again the noise around the pandemic, as you can just see by historical averages, we're pretty good. We don't want to be in the threes. We just don't want to be there. And the fours is a pretty good place to be. And as you can see, the historical average going back to 1960 for the U3s is almost 6%. And for the U6s is just over 10. So again, historical context with some of the media noise. This was what I was talking to you about earlier. This is the growth in household net worth. Again, this is collectively, so obviously people fall on very different ends of this. And this is also too, well, debt levels have increased, primarily real estate, debt levels on real estate. Wealth has increased significantly higher, and that is the driver of collectively overall, even with corrections in the markets, the just extraordinary growth that we've experienced just in the last, say 35 years. Final one I'm going to show you really quickly, or second final, economic policy uncertainty. How can the market be doing so well with all the uncertainty in the world? I'm just going to scan this very quickly. Yes, we are in a time of great uncertainty, and it doesn't correlate to how the markets are doing. This was just a fun one. I think I'll just skip past generational wealth. If you're curious, I'll give this to you, but this is just showing wealth by generation. Obviously, younger people will have less than older people, but it's sort of a fun thing that people get curious about a lot. All right, since we're at the end of our time, that was a quick way of seeing charts. I have tons of charts. If you ever want to see them, let me know. We will be having some speakers coming up. If you remember Bob Stein, our Washington analyst that's connected to all things political, we bring him in every time we have elections. He's going to come in later in the year, and our live event's coming up here sometime spring-ish, as soon as we get those dates confirmed. In the meantime, if there's any speakers that you've heard in the past that you really liked and want to hear again, let me know. ACM speaker, she was really popular, so I'm happy to bring her in. I like it a little mixed, just not hearing Kristina all the time. And to be able to just, again, get some other views, again, get more charts and graphics and things like that. Innovation, if you want to hear the art people, let me know. I can bring Kathy's team in to talk about innovation and things like that. I have access to a lot of really good people. Want to make this hour worth your time. And my highest intention is this was valuable to you. I feel like I just fire hose a lot of information on you with everything happening in the world. However, the intention is again to get this information out there. More questions arise, let me know. I will get you the information you need. If you have questions about your specific strategy, please let me know and I can show you where this is incorporated in your portfolio. So as we go forward to the year of disruptive abundance, just think about disruption is oftentimes what happens before we have this big change. And the change sometimes is scary, it's different, it's new. The media does not do anything to help us with that. And there is a lot going on right now. Focus on what is most important, what is most valuable, and have a good plan in place. And any questions, anytime, reach out. With that being said, thank you very much for listening and look forward to the next one. So I'll see you all next time. Thank you very much. Have a good afternoon. Bye for now.